Hi everybody, my name's Dimitri and welcome to the final session in our course Finance for Non-Financial Managers. Community Business Bureau acknowledges the traditional owners of country throughout Australia. We recognise their continuing connection to land, waters and community. We pay our respects to them and their cultures and to elders past, present and emerging. So to recap, in our last webinar, we spoke about cash reserves and the importance of reserves for a non-for-profit, how to build reserves, the impact that it can have on strategy and budget, and then we spoke about the month ratio as well. So as previously mentioned, this is the last webinar in our 8-part course. As you'll recall, in the first webinar, we spoke about financial terminology and really gave a background on some of the terms that are often used when talking all things finance. We then delved deeper into financial statements and gave an overview particularly of the 3 financial statements, being profit and loss, balance sheet and cash flow statement. In Module 3, we spoke about capturing financial information. And then in Webinar 4, we delved into revenue. Webinar 5 was all things expenses. And then followed by budgets and forecasts in Webinar 6. This then brought us to the last webinar, which was all on cash reserves. Which brings us to Webinar 8, which is the final webinar in our 8-part series, where today we'll be looking to bring a lot of the learnings from the previous seven webinars into each other and really call upon a lot of the knowledge that we have previously built upon. And in today's session, we'll be talking about how to review and analyse your financial statements. So in this webinar, we're going to be talking about a review and analysis of financial statements. We're going to cover the expect to see method, the 80-20 analysis, key ratios and percentages to look at, and a year-on-year review. So as previously mentioned, we'll call upon a lot of the things that we've covered in previous webinars and bring it all together. So without an understanding of how to do a review and analysis, it can be difficult to assess the financial health of your organisation. It can be difficult to review financial results, difficult to explain and present financial results, can have an impact on decision making, and can be difficult to understand and manage risk effectively. By the end of this webinar, you'll know what to look for when analysing financials, what questions to ask yourself when analysing financials, the key ratios and percentages to calculate, and how to conduct a year-on-year review. So the expect to see method, which, as mentioned, we have previously covered in previous webinars. So before even opening up the financial statements and reviewing the numbers, think about the non-financial understanding that you have of your organisation. So when reviewing your accounts, your day-to-day knowledge of the organisation should be confirmed in the financials. So for example, if you know that your organisation receives a grant and donations, then it should be shown as a revenue item in your financials. Equally, if your organisation employs staff, then wages and salaries should be shown as an expense item in your financials. So consider your organisation and what you know about your organisation, and then ask yourself, what do you expect to see in the financials? So the size and complexity of your organisation will of course impact what you expect to see. For example, you may expect to see different things in different divisions or programs. Equally, current and past circumstances will also impact what you expect to see. So for example, a recent or unexpected downturn in donations may expect what you expect to see. So why is this important? Well, this will put you in the right frame of mind before even looking at any numbers. Additionally, key observations can be made very early on. For example, if you don't expect to see substantial wages in the financials and you do, then this could be the reason that the organisation or program is losing money. So let's ask ourselves, for your organisation, what do you expect to see? Think of 3 things that you would expect to see in your financial statements. If you'd like to take it even a step further, you may ask yourself to what level you expect to see that. So for example, you might say, I expect to see wages and salaries. Do you also expect that to be your highest cost, as an example? The 80-20 analysis. So to recap from previous modules, the principle has been generalized to state that 80% of results will come from just 20% of the action. So when looking at revenue, have a look at these as action items. For our organisation, which account, which revenue item makes up more than 80% of total revenue in, say, FY20, it can be for any year, and is a significant revenue item. So what's that one revenue item that's making up around about 80% of total revenue? Equally, when looking at expenses, for your organisation, what's that expense item that makes up 80% or thereabouts of total expenses and is your most significant expense item? For many, this will most likely be wages and salaries. Same thing, but with total assets. So for your organisation, which asset makes up more than 80% of total assets and is your most significant asset item? So for a lot of organisations, this could be cash, as an example. And then looking at liabilities. So for your organisation, what is the liability account or the liability that makes up more than 80% of total liabilities and is a significant liability item for your organisation? So by conducting an 80-20 on revenue and expenses, you'll know what key revenue items drive revenue and what key expense items make up expenditure. This is important for 2 reasons. It helps you further understand your organisation from a financial perspective, and it allows you to concentrate on key items rather than getting caught up in immaterial items. So to recap from webinar 4, your business model is your organisation's plan to meet its social objectives whilst remaining financially sustainable. An 80-20 analysis on revenue will reveal how your organisation plans to meet its social objectives, while an 80-20 analysis on expenses, assets and liabilities will help in assessing the financial sustainability of your organisation. So key ratios and percentages. There are 1,001 different ratios and percentages that you could, of course, calculate in your financials. The question is, what are some of the key ones that you may want to look at? So here we have 5 things to look at. The first being revenue concentration, the second being net profit margin, staff to revenue percentage, current ratio, and the month ratio. Revenue concentration identifies the percentage of total revenue that is derived from a particular revenue item or a type of revenue item, such as grant funding. So you will recall that this was covered in our topic specifically on revenue. So this highlights the reliance on a particular revenue item or types of revenue. And it also allows risks associated with certain types of revenue to be considered. So for example, if you are grant funded and your organisation is funded only by 1 or 2 grants, it is therefore heavily reliant on a particular grant for revenue. And there are, of course, risks associated with having a high concentration on just one or two types of revenue, because if that revenue goes away, then it could mean that the organisation may no longer be able to operate, as an example. So how do we calculate revenue concentration? So quite simply, have a look at the line item, the specific item. So in this example, we're looking at grant revenue. Have a look at total revenue, divide the two by each other to get a percent. So in this example, grant revenue made up 65% of total revenue in FY20. The net profit margin. So net income is the income or profit that remains after all expenses are subtracted from the revenue generated. The net profit margin is equal to how much net income or profit is generated as a percentage of revenue. The net profit margin highlights sustainability of an organisation to be able to cover all of its costs from the revenue it generates. Additionally, surpluses are required to invest in organisational improvements and capital expenditure, such as IT systems and office upgrades. Often, not-for-profits may think at times that they need to operate at a completely break-even level. It's worth mentioning here that future capital expenditure, office upgrades, new computers, those sorts of things are often funded out of cash reserves, as covered in the previous module. And in order to build cash reserves are often built through generating surpluses in previous years. So as covered in the previous module on cash reserves, your net for profit margin can very much impact your ability to build cash reserves in future years. Furthermore, it's also worth mentioning that some might say that if your net profit margin is below the inflation rate, say inflation's 2% and your net profit margin is 1%, then there's an argument that you've actually operated at a loss for that year when taking into account inflation, as an example. So how do we calculate the net profit margin? Quite simply, look at your net income. So in this example, it's 50,000 and divide it by total revenue. So here we have 50,000 divided by a million gives us 5%. So the net profit margin in FY20 for this example was 5%. Another way to rephrase this and also look at that is for every dollar that's generated in revenue, 5 cents profit or surplus was earned. As previously mentioned, staff are often an organisation's single biggest cost, and for that reason, it's worth looking at the staff to revenue percentage. So the staff to revenue percentage calculates wages as a percentage of total revenue. You may choose to include superannuation in your calculation. It's entirely up to you. Note that superannuation is a compulsory payment that's required in Australia, so it may be prudent to also include that in your calculation. So how do we work out the staff to revenue percentage? Quite simply, we look at the wages and if you're including super as well, and divide those items by total revenue. So in this example, we have wages of 700,000, superannuation of 66,500, and total revenue of $1 million. So 766,500 divided by $1 million gives us a percentage of 76.65%. So in this example, the staff to revenue percentage in FY20 was 76.65%. So again, another way to rephrase that and look at that, for every dollar that is generated in revenue, 76.65 cents was spent on wages and superannuation. So this is a really good percentage to look at in terms of how much is being spent on staff. And often if costs are increasing and surpluses are hard to generate, or if you're running at a loss, this is often a very good starting point to look at. The current ratio, arguably one of the most popular ratios, compares all of an organisation's current assets to its current liabilities. So to recap, these are usually defined as assets that are cash or will be turned into cash in less than a year, and liabilities that will be paid in a year or less. So again, just a recap on the definition of current in terms of assets and liabilities. So the current ratio is a liquidity ratio that measures an organisation's ability to pay short-term obligations or those that are due within a year. And it's calculated by having current assets divided by current liabilities. A current ratio below 1 means that the organisation doesn't have enough liquid assets to cover its short-term liabilities. It's alarm bells, definitely something to have a look at, and it may mean that the organisation is potentially trading insolvently. A current ratio of between 1.5 and 2 is generally considered a good ratio. So one of the reasons that the current ratio is such a popular ratio is that it highlights an organisation's ability to meet its upcoming obligations. And of course, that's a very important thing for a number of reasons. So again, it's quite a simple calculation to calculate. We look at the current assets and we look at the current liabilities and we divide them by each other. So current assets of 1.5 million, current liabilities of 1 million gives us a current ratio of 1.5. So in this example, the current ratio as at 30 June 2020 was 1.5. Another way to reword that is that the organisation can cover its current liabilities 1.5 times. The month ratio. The month ratio that we spoke about in our previous module, the month ratio outlines the number of months of cash currently available to cover expenditure. Put another way, how many months can you pay your current level of expenses if revenue stopped tomorrow? 3 months is often quoted as a minimum number. However, the appropriate number will always be unique to each organisation. In determining this number, you should consider future capital requirements, so things such as IT upgrades, office upgrades, new equipment, those sorts of things. Any potential revenue loss, such as the loss of a grant. So, for example, if you're unsure if your grant is going to be renewed in 6 months' time and you would like leeway to be able to operate for a couple of months before making any decisions, or you need a couple of months to be able to make certain decisions, then this will of course come into determining what you think the appropriate level of cash reserves and subsequently month ratio should be. Other things to consider will also be any potential redundancies and staff entitlements that you'll need to pay out, and any other scenarios really that may require your organisation to need cash for a particular cost or period of time. So as you recall from our previous module, not-for-profits often don't have the same ability as for-profit organisations to be able to quickly access cash. So being able to have cash reserves and access those cash reserves is vitally important for not-for-profits. So how do we calculate the month ratio? Again, it's current assets less our current liabilities divided by total expenses less the non-cash item of depreciation. And again, just to reiterate, we'll be looking at usually a 1 year period. So current assets and current liabilities, as you'll recall, are always as at. However, for total expenses less depreciation, we'd be looking at a 12-month period for those numbers. Multiply that number by 12 and that will give you the number of months. So you may be asking yourself about how to do a year-on-year review. So in addition to reviewing the most recent financial results, it's also beneficial to review results against past results. So reviewing recent results against past results provides insights into how the organisation has changed and can highlight both positive and negative movements that may need further attention. So a year-on-year analysis can, in theory, be done on all the numbers that you have current and past year results for. However, key items to review include revenue, net income, cash, and net assets. The key ratios and percentages to review include your net profit margin, your current ratio, and your month ratio. If your organisation maintains financials for individual divisions, it's worthwhile also doing a year-on-year review for each division and program. So you may wish to understand how a particular program from a financial perspective has changed over the years. And if your organisation captures and records that information for that particular division, then of course you can do that. So the net profit margin, we have an example here. So looking at FY19, the net profit margin was 4%, and in FY20 it was 6%. So the net profit margin has increased from 2% in FY19, from FY19 to FY20. So this may indicate that the organisation is able to generate revenue in a more efficient manner. This could be, for example, by increasing revenue and not having to increase expenses at the same rate. It could also mean that the same level of revenue was able to be generated with lower expenses. In terms of a current ratio example, we have here that in FY19 it was 1.5 and in FY20 1.8. So the current ratio has increased 0.3 from FY19 to FY20. So this may indicate that the organisation is better able to cover its short-term liabilities. The month ratio. So in FY19 we had 2.3 and in FY20 4.1. So the month ratio has increased 1.8 months from FY19 to FY20. So this indicates that the organisation will be able to sustain its current level of expenses for longer should revenue cease, and that it's generally in a more financially stable position. So when looking at these three as an example, we can see that the organisation is operating in a more profitable manner in FY20 compared to FY19. It's more liquid and more easily able to cover its short-term liabilities, as evidenced through an increase in the current ratio, and is generally in a more financially stable position after holding more cash and increasing its month ratio by 1.8 months. So overall, that should tie in with your understanding of how the organisation has changed, and by all accounts, these would be positive results to look at on face value. So in conclusion, today we've covered the expect to see method, what we expect to see before even looking at any financials. We've revisited the 80-20 analysis and the importance of having a look at particularly revenue, expenses, assets, and liabilities. We've covered a number of key ratios and percentages to hone in on and look at. And we've also covered how to conduct a year-on-year review. So that brings us to the end of part 8 of our 8-part course on finance for non-financial managers. I really hope that you've enjoyed this course and picked up a number of key beneficial learnings. My name is Dimitri, and I'd like to thank you for taking the time to participate in our course. We will be sending through an exit survey for feedback and would love to hear what you thought of the course. Thank you again.